What's good, everyone, and welcome back to the Financial Four channel. We are on our free money glitch series #1, giving you an intro on how to completely glitch out the whole system with options trading. So in the first part of the option trading module, we'll explain what an option is and the important components and terminology of an option contract that you need to be familiar with. So grab your notebooks, buckle up, hands and feet inside the right at all times. Let's go glitch this money. So with many traders and investors terrified of the risk and possibility of significant losses associated with them, the word options is one of the most feared in the financial industry. A product can be extremely risky and dangerous when investors just don't understand it, okay? Options, when used correctly, is one of the safest financial trading instruments available, and is one of the few instruments that can provide a specific dollar outcome regardless of the market behavior, okay? So what are options? Option contracts are used for many different purposes that can range from purchases of land and buildings to manufacturing supplies and infrastructure. Option contracts can come in, many different styles and forms, but we'll just focus on what they call exchange traded options, ETOs. The CBOE, the Chicago Board Options Exchange in the US, is a place where the ETOs are traded, and ETOs are basically guaranteed through a clearinghouse, okay? So option contracts basically represent a set quantity of a specific financial product, okay? Generally, an option contract represents 100 units of the underlying share. So as an example, one option contract of Commonwealth Bank, we'll call it ticker symbol CBA, all right, represents 100 shares of the company. There are some instances where individual companies have a number different to 100 due to specific and special conditions and share placements, etc. So just be sure to always check the correct number of units when your broker with your broker prior to placing a trade. It's also important to note that option contracts on assets and other financial instruments such as indices and commodities can represent a different number of underlying units. Okay, so how options operate in its most basic form, an option contract is a contract which allows the option buyer the right but not the obligation to buy or sell an asset at a predetermined price in a specified time frame. Okay, and there are always at least two parties in an option contract transaction. There's the option buyer, some people call it the option holder, and an option seller, some people call them the options writer. Okay, and so we'll use a non-financial example to help clarify this, to show how an option contract functions in detail. And this will also help depict how an ETO would operate in the financial markets. Okay, so let's say we have TJ, the option buyer. He wants to purchase a racehorse from Shanae, the option seller, for $10,000, but needs to save up to pay for the horse first. The horse has a race in a few days, and if it performs well, it could be worth more than the current value of $10,000. Conversely, if it performs poorly, its value could drop and it could be worth less than $10,000. So TJ really likes the horse, and he isn't willing to take the chance that he may have to pay more for the horse in the future if it performs well. So TJ asks Shanae to not sell the horse to anyone else for 90 days, allowing him to save up enough money. TJ offers to pay Shanae $300 to sell the horse to him in 90 days for the agreed amount of $10,000. If TJ can find the money to pay for the horse in 90 days and he still wants to buy him, he will pay Shanae then $10,300. That's $10,000 for the horse, and then $300 for holding the horse for him for 90 days. Okay, so if TJ can't find the money, or he changes his mind about buying a horse, he can walk away with no further obligation or cost other than the $300 he paid Shanae for the option to purchase the horse in 90 days. Okay, TJ and Shanae basically have effectively entered into an option contract with a 90-day expiration date at a strike price of $10,000. Okay, so why would TJ pay $300 to Shanae to lock in a fixed price? From TJ's perspective, he is giving himself the opportunity to own a racer for a fixed amount, that's $10,000, with all the upside potential. If the racehorse were to win or perform, exceptionally well over the next 90 days, without a fixed contract in place, TJ may have to pay, far more for the horse than the current value, right? So just as importantly, TJ can walk away from the transaction if the horse doesn't perform well as expected. And, there are many things that could go wrong with the racehorse as well in 90 days. You could get sick, injured, it can perform badly, those type of things. So TJ has effectively removed the risk out of the transaction and given himself a chance to evaluate if the horse is still worth $10,000 after 90 days. The opportunity to buy the racehorse for the current value of $10,000 in 90 days has also come at a cost of $300. And then later in the module, we'll go into more detail about brokerage fees, related to option contracts. But options in financial markets are a contract that enables an investor to buy or sell a specific financial product that the option is intrinsically linked to. Options are known as derivatives because their price is derived from another financial asset. So as an example, if you have an option contract on CBA, Commonwealth Bank, the price of the option contract will fluctuate in line with the rise and fall of the CBA share price. So it's important to understand that just like in the previous racehorse example, the buyer of an option has the right but not the obligation to buy the underlying asset at an agreed price to a specified date. So as an example, if a trader was to buy CBA option contracts at a strike price of $80 with an expiration date of June 26, they have until the close of trade on June 26 to exercise the option contract and purchase the agreed number of shares at a specified price. Okay, so remember these three terms: strike price, expiration date or expiry date, and exercise. Okay, we'll talk about it later. So despite the broad range of option strategies you've probably heard of or you're familiar with, there's really only two types of options. There's your call options and then your put options. Okay, so call options in the finance market are best described as financial contracts that give the call option buyer the right but not the obligation to buy a financial asset at an agreed price within a specified time period. The financial asset, remember, it's called the underlying asset, and the call buyer profits when the underlying asset increases in value. Okay, calls are up, and we'll talk about the next one later. Puts are down. Okay, so every option transaction involves at least two parties. Remember, and there's the option buyer, then the option seller. Okay, so buying a single call option contract on CBA will give the call option buyer the opportunity to make money from a upward movement in CBA above the $80 strike price up to the close of the trade on June 26th. Okay, so from the standpoint of the call option seller, selling a single call option contract on CBA will obligate the call option seller to deliver 100 shares or CBA shares to the option buyer at market close on June 26 for an amount of $80, which is the strike price. Okay, puts are the opposite. Same thing, but the opposite. Put options in the financial markets are pretty much best described as financial contracts that give the put option buyer the right, again, but not the obligation to sell a financial asset at an agreed price with a specified time period. The financial asset, again, it's called the underlying asset, and the put buyer profits when the underlying asset decreases in value. Remember, call options are up, put options are down. Okay, so for instance, purchasing a single put option contract on CBA will give the put option buyer the chance to profit from a decline in the CPA or CBA Commonwealth Bank below $80 the strike price up until the close of trading on June 26th. Okay, so selling a single put option contract on CBA will obligate the put option seller to buy 100 CBA shares at the close of trading on June 26th for a price of $80 the strike price from the put option buyer. So this is a very, very vague and basic explanation of what a call option and put option is. So don't worry if you're having trouble, working out why each of these parties would enter into this agreement and all this other stuff and terminology. We'll explain, the benefits of each side and the terminology later in the module, okay? So European options and American options are two primary option types you will encounter in the financial market. The important thing that you need to be aware of between the option styles is how the expiration methods differ from each other. Both have an expiration date built into the option contract, but the difference lies in how they can be exercised. So an American option can be exercised by the option buyer at any time up until the expiration date, right? This means that if the option buyer held a 90-day call or put option on CBA Commonwealth Bank, which had an expiration date of June 26, they can effectively exercise that option on any date between when they first purchased the option right up until the close of the trading day on June 26. On the other hand, European options can only be exercised on the expiration date, right? So this means that if the option buyer held a 90-day call or put option on Commonwealth Bank CBA, which had an expiration date of June 26, they can only exercise that option at the close of trade on June 26. So there are a few reasons why, one option style may be more suitable than, the other at different times. And we'll explain this, later as we progress through the module, okay? So just some option terminology here. The option terms, we used earlier to describe an option contract are universal. And so we'll basically now break down each term to give you an understanding of what each term means and how it relates to an option contract. To help explain these terms, we'll try to use, some data from the Commonwealth Bank CBA example we used earlier for both call and put options. So strike price, you heard me talking about strike price before. The strike price is the agreed price that is unique to the option contract, okay? So there will always be several different option strike prices, okay? So in the CBA example, Commonwealth example, the strike price is $80, right? This is the price the option seller has agreed to sell the CBA shares to the option buyer, okay? Then there's your expiration date. So every options contract has an expiry, and this is the date at which once passed, an option can no longer be exercised. So in the CBA example, the expiry date is June 26. So it's important to note that the expiry date refers to the close of trading on the expiry date for shares. However, for indices, the first tick on the expiry date confirms the price that will be used to close off the option contract, okay? Then there's your exercise price. So this occurs when the owner of an option takes up their right in the option contract. So the owner of CBA option buys or sells their amount of CBA shares at $80 the strike price, and the option seller is required to take the other side of the trade. So remember that for every option buyer, there must be a seller. So each option contract will always involve a transaction with at least two parties, okay? So as a side note, the reason why there could be more than two parties in a transaction is purely because the transaction is facilitated by a regulated exchange, okay? The buyer of a call, will never know the identity of the call seller and vice versa. But as an example, if a call buyer wants 10 contracts of an option, one call seller may not have enough contracts on offer. Okay. In these instances, what the exchange would do, the exchange can still facilitate the trade, but it will use the same option contract from multiple call sellers to fulfill that order. Okay. In this example, as you can see, there may be a call seller wanting to sell 3 contracts and another wanting to sell, 7 of the same contracts that the call buyer is requesting. Okay. This means that there are enough contracts on offer for the call buyer and the trade will be executed by the exchange. Okay. So then there's assignment. So assignment is when an option buyer exercises an option. An option seller is assigned and must, fulfill their obligation. So as an example, if the CBA stock is trading at $90 at the expiry date, the option seller is obligated to sell the allocated CBA shares at $80 to the option buyer. Okay. Then there's in the money. So for call options, this means that the strike or the stock price is above the strike price. Okay. Stock price is above the strike price. This means that if the CBA stock price is trading at $90, because the strike price is $80, the call option is $10 in the money, quote unquote. Okay. In the case of put options, it means that the stock price is below the strike price. As an example, if CBA is trading at $70, because the strike price is $80, the option is $10 in the money, quote unquote. Okay. Then there's your out of the money. So when a call option is out of the money, it means that the stock price is lower than the strike price. Example, if the price of CBA stock is $70 and the strike price is $80, right? This is what they call out of the money. This basically implies that the strike price is higher than the stock price is higher than the strike price for put options. According to the previous illustration, the option is out of the money if the price of the CBA stock is $90 and the strike price is $80. Okay. And then there's your at the money. So for both call and put options, this means that the stock price is equal to the strike price. So it's basically important to remember that the strike price and the stock price will very rarely be exactly equal. And even when they are, it does not, remain so, for long, due to market fluctuation. So as such, when purchasing options, the strike price closest to the stock price is generally referred to at the money. So as an example, if the CBA stock is trading at $79.90, it would be considered at the money with a strike price of $80. Okay. Then there's your intrinsic value. So intrinsic value is the amount an option is in the money, quote unquote. It's important to remember that only options that are in the money will have intrinsic value. As an example, for a call option, if the CBA if the CBA stock price is trading at $90, because the strike price is $80, the call option has an intrinsic value of $10. In the case of a put option, if the share price is trading at $70 because the strike price is $80, the put option has an intrinsic value of $10. Okay. Then there's your option premium. Option premium is the market price of the option. This is effectively the price paid for the rights that the call or put option provides the option buyer, and this is paid, to the option seller. Okay, that's the premium. So then there's your time value. So time value, aka they also call it extrinsic value, not intrinsic, extrinsic value. This part of an option price is based on, its time to expiration. So when the amount of intrinsic value is subtracted from an option price, option premium, only time value remains, right? So if an option has no intrinsic value, which is basically options that are out of the money, its entire value is effectively time value, okay? This is great for long-term option contracts, okay? What they call leaps, and that's a whole another thing we'll talk about later. So this section is designed to provide you with a very basic intro and overview of what options are and how they work. But this information will form the structure for the remainder of the option module. So if there's any part of this section you don't understand, you don't completely understand, it's very important to review it again prior to progressing to the next section to ensure you don't have difficulties for the remainder of the option module. Okay, stay tuned for part 2. This is Bradley Barnett. I love y'all from yours truly, Financial Freedom.